Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets. Don't make any sense, but they might actually be starting to. I know it's hard to believe, but the Fed did begin their, I was about to say rate cut, but it's not. I don't even have an official name for it, but we'll just say not QE because it's not quantitative easing. But it kind of looks like it. But it's not, but it kind of is. So until they give us an official name for it, we'll just say their latest bond purchase program. Now, I do want to talk about bonds today, quite a bit of interest rates. I've got a lot for you on that. But I want to talk about this dollar liquidity problem. I'm not sure everyone really understands truly what it's like. And so let me see if I can put it into a way that you can understand. Since we went onto the dollar standard in 1971, where we dropped being on the gold standard, this is the largest contraction of dollar liquidity in the history of the US dollar, meaning the Fed has destroyed so many dollars globally, more than the great financial crisis and more than during the dot-com bubble. Put that in perspective, it's like being dehydrated. And so maybe let's say I haven't had any water all day, and my friend who gave me this wonderful ExxonMobil pipeline oil mug, who might be watching, hello, my friend. He says, Steve, let me help you out. I'll get you some mugs full of water. So I drink them, for maybe 5 mugs of water, and man, all of a sudden I start to feel better. That is hydrating to the need. So here's enough water to rehydrate. Now let's just say instead of bringing me a nice oil barrel mug, he brought me like 8 shot glasses. Said, the little ones. Here you go. Yeah, I'm not really getting very hydrated here. Those little shot glasses is pretty much what the Fed is doing in terms of buying $60 billion of Treasury bills, which are 1 year or under maturity. They're focusing on 3 to 6 month maturity. That's what this is like. Because so many people say, well, but the Fed's buying. The stock prices have to go up. Interest rates have to go up. That's what happened in QE 1 through 3. Right. QE 1 through 3, I said, hey, I'm dehydrated. They backed the fire truck up, hooked it up to the hydrant outside, and blasted my face with water. That's QE 1 through 3. That was enough liquidity to effectively monetize a huge chunk of the U.S. deficit. $60 billion a month. They're estimated to do it for, so we'll just say 6 months. Round up to $400 billion just because they'll probably go a little bit longer. I'm not actually convinced they'll even stop, but we'll just give the Fed the benefit of the doubt. Deficit this year is expected to be 1.1 to 1.4 trillion. So yeah, it's not going to make a massive dent. But what it is going to do is cause short-term interest rates to go down, pull liquidity out of the stock market. We started to see that today, where stock prices were trying to rise, bro. It's kind of like one of those movies where the monster is still trying to live and it's on the ground. It's like, rah. That's like those computer algorithms that are buying stocks. They're trying bid, and then, oh, no liquidity. Bid, no liquidity. Because the Fed doesn't actually even know what the real problem is. And I'm going to tell you I'm going to write about for next week's update. I'm going to tell you right now what the real problem is. The Fed has an overnight dollar liquidity problem. Today it was one of the largest days of dollar demand, on top of the fact that they bought $7 billion. I don't remember how they did QE 1 through 3. I like to think, we need $60 billion. They went and bought it all once. I know they didn't do that. Of course, I was fairly new in the business at the time, so I didn't really follow it like I do today. But today they bought $7 billion worth of T-bills. Now, I did the math, and that equates to about 8.5 trading days a month to reach their target. I don't know if they're going to do it all at once in terms of first of the month through the first trading 8 days, if they're going to do 2 a week. I don't know. No idea what they're going to do. It's just not that much. But the reason the Fed sees a problem is they're seeing the federal funds rate, or the overnight banking rate, spike. And it spikes because normally what happens, like I'm a bank, you're a bank, let's say I'm short money for the overnight rules. I come to you and you loan me some money at the federal funds rate, and then I give it back to you in the morning. And even though the big banks on paper look healthy, we have to assume they are. Now, mind you, there's 28 banks that can participate in this. They don't want to lend to each other. They're like, yeah, I know you're looking okay, but I don't trust you. I don't trust you at all. Now, we don't know which banks these are. The Fed obviously is not going to tell us. But they don't trust each other, and that's not good. But nevertheless, that's what's going on. So the Fed is stepping in to add this liquidity. So what does the Fed focus on, right? Tunnel vision on this overnight lending rate. But that's not the problem. Yesterday, I saw a chart someone put together of the overnight, what are called repo demands. And they showed, like the term repos, which are more than overnight, and then the overnight ones. And they had a nice graph. And I was looking, wait a minute, that looks exactly like 10-year Treasury yield. Because it does. It is. So I'm going to tell you something that if the Fed knows they're not going to publicly admit, but publicly the Fed says this is a short-term interest rate problem. So what is the Fed going to do? Lower short-term interest rates. What I'm telling you, it's not. It's a long-term interest rate problem. Long-term interest rates are too high and they need to come down. And that's what makes this interesting, because if you stop and look at how the smart money is positioned, they've been buying bonds for 8 years. The biggest topping pattern in 10-year Treasuries in history. Close to breaking. What do they want to do? They want to get paid. They want to sell those bonds to the retail public. Who's been buying them? Commercial banks and securities dealers. And I just got word today from the Treasury. Well, they didn't call me. I found it on their website. The foreign central banks bought $200 billion worth of U.S. Treasuries in August. So the biggest players, the three biggest players on top of the Fed, are buying bonds. And everyone says bonds are bad. Go figure. The biggest players are buying. So I forgot where I was going with this. But anyways, I was looking at this chart and I went and looked at 10-year Treasuries, and I'm clear like, no, the Fed, here's where I was going with it. The monetary system is trying to bring long-term interest rates down, but the Fed doesn't control long-term interest rates. They lost control of that when we went off onto the dollar standard. And they publicly figured out that they went off in 1981, but you will never hear them mention it unless you read the paper that they have on their website. So the Fed can't control long-term interest rates. The banks know that because they're the smart money. They're really smart. They know it. So what do they give the Fed the impression there's a problem? In the short-term interest rate market, because guess what the Fed can tackle? Short-term yields. So the Fed's going to start driving down short-term yields until long-term yields fall, which will cause a massive short squeeze on all the speculators who are shorting the bond market, which will cause the stock market to fall, as it always does. And at that point, you're going to watch all the smart money start unloading these bonds on the unsuspecting speculators and retail investors who start running for cover. And that, my friends, is how it's done. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in the video that anyone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let me pull up that chart there. Okay, here is major foreign holders of U.S. Treasury securities as of October 16th, published today for the month of August. And we can go down here, and the total amount, you can see, went from 6.6 trillion, 6.63, 6.85. So we'll just round up and say $220 billion of U.S. Treasury securities were bought in August, broken down to some short terms and some long terms. So the major foreign holders of Treasury securities, translation to foreign central banks, are buying bonds in a big way. Looking at liquidity, the NASDAQ McClellan summation index is down to minus 205. We're looking at if we can get below minus 300, where it stalled out the last two times. That would push liquidity down and really cause markets probably to sell off. Now, we are kind of seeing that in the market today. just for fun, we don't look at daily charts normally, but just for fun, normally what we've been seeing in the market is ramp, and then sideways, ramp, sideways. But look today, ramp, and then after hours, Netflix is up. I think that's probably helping the market a little bit, even though their numbers weren't nearly that great. So let's talk about the long-term bond market. So here we'll look at 10 years first. So in August, right here, so between here and here, foreign central banks were buying $220 billion of treasuries, driving interest rates down, which is good because if you want to fix world dollar liquidity, you have to do that. Now, what does everyone think? Oh, interest rates are going up because Fed's doing QE again. Sorry, it's not going to work that way. But when you have the biggest players in the pool not budging, it puts a limit on where they can go. So you notice they ran up here and then came back right down to where they were buying. And now they've run up again. And where do you think they're going to come back down to? Where they were buying. Let's just chat on world dollar liquidity real quick. So remember I said how you fix that? You have two things that have to happen. One, the Fed has to either cut interest rates. Well, they have to cut interest and do quantitative easing or something that looks like it, but we can't call it because they don't want us to. So they're doing that. And I do believe the Fed is going to cut in the end of this month. And part of the reason is 5 members of the Federal Open Market Committee voted for a rate cut. So that's 5 out of 12. Probably going to tilt that way because the economic data is not showing an expansion here. It's showing a contraction, which we know because I've shown you the charts where short-term interest rates go down, and guess what? The economic data comes down. So we know that's going to happen. The other part of the player that needs to happen is foreign central banks or foreign investors need to buy Treasury securities, and they are. And when everybody starts buying bonds on both sides to get world dollar liquidity up, you get a recession every time because you can't contract this thing. All right, so let's go look at bonds and focus on the 30 here. So I realize everyone's kind of worried about this. So let's zoom out and then we'll zoom back in. So here's what happened. Looked like it was going to break down lower, tagged the all-time lows, didn't. Short sellers came in here. And the reason we know it, even though you don't see trading volume here, we could go look at the corresponding ETF and we see a lot of trading volume right here. In fact, we'll go do that. Let's see, here it is. And this, is right here, is what you call stopping volume. So when you see a down move in price and you see a big slug of volume, what this is saying is there's a lot of sellers here, but then there was also a lot of buyers. Because remember, half is buyers, half are sellers is how it always is. So when you see a big shoot up in volume, what you have to think here is, oh, the big players were bringing this down because they wanted to buy more bonds. Now, why would they want to buy more bonds? Because the Fed's buying and foreign central banks are buying, and the big banks know that, and they're probably buying because we'll get their data on Friday. So we know they want more bonds because they want to make some money on it. Then in Monday, when bond market was closed, prices came up on low volume. That would be expected. And normally when you get stopping volume and they put the big stop sign up, it doesn't mean that immediately it goes up the next day. Usually there's 2 or 3 or so days afterwards where it kind of peters out. And it does that to flesh out the sellers. So people say, well, the bulls need to step in. No, the bulls need to wait until the sellers do what's called exhaust themselves, where they're tired of selling. So we know the sellers were really dominant right in this range right here. So let's go back up to yields, and we'll zoom back in. And what happened during those moves, it came up to where there was one of these lines here, and I've added another, and I'll show you what the relevance is. But you see it hit resistance here. Next day really didn't matter. You will notice, though, in overnight trading between close and open, Asian and European markets, there's buyers. The next day, there were buyers, and U.S. investors shorted this thing up. Today, overnight, Asian and European investors were buying. U.S. investors shorted it higher, and then the market brought it down as QE kicked in, and almost immediately did yields tick back down because I said that's what's going to happen. Now, why are those two lines relevant? Well, let's go take a walk over to here. And we come back to 2016. And you can see this was the bottom of the Treasury bond or Treasury yields in 2016. See where I got those two lines? This is resistance. And now let's zoom out so you can see where I'm referring to. We're right here. See all this trading going on here? This is resistance. Now, why does this matter? Because this is where people less than 4 years ago bought 30-year bonds. And who buys 30-year bonds? Pension funds will buy them, institutional money managers, and foreign central banks. People who have mandates to buy them who generally aren't speculators. They're not looking to sell them. So you don't look at that spot on the chart and say, oh, that's a bunch of people that are looking to get in and out. No, these people bought and held. So why is the market interested in that level all of a sudden? It wants to know if those people have changed their mind and want to sell. Or if they're happy with their purchase back then, less than 4 years ago, and maybe want to buy some more. So the fact is, we saw effectively 3, maybe a half days where the market did not breach this zone. Now it could breach it a little bit, but you notice it kind of came up and it's running out of steam. And we saw the trading volume. We can go back to, and you see the trading volumes here is pretty low. So it's telling us the sellers were pretty dominant right into here, these two spots right here or right here, and they're running out of steam. So what normally happens at this point, because remember I said there's going to be some volatility, there's going to be some upswings and downswings. And why does that happen? Because the big players need to kind of shake out all the weak players, the short sellers. So what should we now expect to happen? Maybe not tomorrow, I don't know when, but what we should expect then is yields to go back down into here to find out if these short sellers want to short some more. And if they're done, then it will continue to move down. If they're not done, then they will try again. And this will go over and over and over again until it's done. And this happened back in 2008 before the big bond market breakout. The only question we have now is after 8 years of selling bonds, how much ammunition do these players have left? And if they don't have much, then they'll be flushed out because now you see the biggest players are buying. And the foreign ones were the ones we really wanted to see buy, and they're in. So they're in, the Fed's in, securities dealers are in, and the commercial banks, we'll find out Friday, I bet, then we know they're buying mortgage bonds and they've been buying treasuries. They scaled back a little in the treasuries, probably just to get some of these short sellers excited. But you can tell we're almost there. So this backup yields is not a big deal. In fact, today, 5 and 10-year yields fell far more than 30-year, meaning the 30-year yields are likely to follow suit. And I should suspect that sometime into next week that we'll see a nice reversal to see where the rest of the short sellers are. I'm Steve Van Metre. I'll see you Friday. Bye now.